From the morning reading, stocks under pressure with Monday morning sell-off, led by XLE. Oil falls below $37. 2 of 9 sectors moved higher on Monday. XLY, XLU, and XLF were the strongest sectors, while XLE was the weakest sector. Breadth weakened as decliners led advances, 1.58 to 1 in the New York Stock Exchange and 1.67 to 1 on the NASDAQ. December has been unusually volatile for stocks. The S&P has seen its third most volatile December since 1928, and the Dow Jones Industrial Average also ranks among the top. Some are concerned that an unusually volatile December suggests even more bumps ahead, especially if stocks are trading near their highs. But going back to 1900, there is no support for that concern, as the Dow tended to provide unusually positive returns across almost all time frames. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:45 a.m. Central Time, and I'm recording this in preparation for the market day of December the 29th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And it's pretty solid overnight action, especially if you consider, and we'll look at the charts in a moment, midway through yesterday, we're down, fairly decently. Then the bulls rallied back and then continued that progress into the overnight. At the time of this cut, the S&P futures were up almost 10 points, or about 0.5%. Russell futures were up about 1/3%. NASDAQ futures up about 0.5%, as was the Dow futures. Crude oil futures were up about 0.75%, and that seems to be the correlation driver with the market of late. Whatever oil seems to do seems to be driving the market in large. In terms of the euro, it's essentially scratch. Bonds are down about 1/3%, and gold up marginally. In overseas action, all positive. China was up about 0.8%, Hong Kong up about half that, Japan up about 0.6%, Germany up 1.6%, and United Kingdom up about 0.4%. In terms of macroeconomic reports for today in the United States, you have a goods trades balance and consumer confidence once the market opens. And then tomorrow, and looking ahead, we have pending home sales and the usual weekly crude oil inventory report. Note that Japan will be on bank holiday tomorrow, so we may have some influence from that in the Asian markets. Of course, we go into our partial day on Thursday, half-day market. There will be some macroeconomic reports on that day, and then of course Friday the markets will be closed in the United States. In terms of current volatility conditions, relatively benign yesterday. Short-term VIX 15.79, IV percentile 22 on the S&P, 20 on the Russell, 20 on the NASDAQ, and 20 on the Dow. No standard deviation moves were put in yesterday, and that's the first time in quite a number of full-time sessions that we've not had a standard deviation move put in. There was pretty good intraday action, and it certainly was heading for that kind of standard deviation changing move, but by the end of the day it was basically a doji, and we were basically back where we started. Let's go ahead and take a look at those charts. On the SPX, as I said, very much a doji. So the good news is intraday there was a huge reversal, and we were able to get back to almost even, not quite back to the prior close, and especially if you think about it, the prior full day cash and close. So we are weaker. We have set up something of a pullback, but in the very, very short term, it would seem to be bullish at this point. The more intermediate term, this is still right smack in the middle of a range, and we've had on the S&P at least, a series of lower highs and then now higher lows. and we're looking for to see where this kind of breaks out of this pattern. Might not happen this week. We might have to wait until January to see resolution of this pattern. Seasonality wise, we normally expect this week to be somewhat bullish, and wouldn't be surprised if we get up here to around this area where you had this kind of tweezer pattern or dark cloud cover pattern, kind of reversal that set up some of this more short-term weakness, that we might get up into this 2075-ish area. Would not be a stretch if we were to see fulfillment of that seasonality bullish pattern. That we would get past that would be somewhat surprising. On the flip side, also would not be surprised to see us down here in the cloud chopping around, doing more of the same of what's been happening. So those are kind of your two patterns that could follow through, and neither one of them has an awful lot of probability to it. This is a really, really weak setup right now, and not really very conducive to directional trading, frankly. Perhaps if you like to trade both sides and have some bullish, some bearish, and take opportunities when they present, that might be a way to go, but that would be certainly more aggressive, more speculative in nature. In terms of Dow, very much a similar pattern to what we had on the S&P, and then the NASDAQ, also similar pattern. It actually eked out a small positive day, but again did not get back to the close of the last full trading session. In terms of the Russell was weaker than the others. It did have the intraday reversal, but has a decidedly larger down body, and that did not come through all bulls all the time yesterday at all. Volatility did drop, and you see current volatility through last night. We're down below an 18, so that's kind of the range of the bulls. And certainly no extreme volatility fear premium being priced into this market at this time. Let's look at the bond futures. Bond futures are still in a consolidation pattern and smack in the middle of a flat cloud. So very, very indecisive, very much like our broad market indices. Let's go on to the daily report. Still fairly ugly here, but with lots of mixed signals. We're clearly still a market in transition or consolidation, and the big question remains, do we break from this consolidation pattern into a continuation pattern to the bulls and set new all-time highs and beyond, or do we have a topping pattern in progress and we eventually break down? It is pretty much a coin toss as to which direction that's likely to go at this point. But in terms of the mechanical signals, the IBD status is uptrend under pressure with an accumulation distribution score on the S&P of a D-, and the NASDAQ at a D. GMI index fell a notch to 1 out of 6 and remains a sell signal, and that author remains 100% in cash. In terms of decision point scoreboards, short term continues to look very ugly, intermediate term bullish, and long term very mixed. Consensus of all these signals is market in transition with not a lot of bias one side or another, but if pressed, I would say it would be the bias to the bear side at this point. That's reinforced, that sloppiness, by the intermediate term market posture. It has now turned back to bullish, but we have a slightly bearish sentiment line. So just more of this same kind of sloppiness that is being forecast by these various indicators. Position sizing opinions, relatively defensive. Portfolio sizing opinion is up to 50%, whereas volatility active trader is a 75% plus. Intermediate term market posture on the individual indexes are all bullish now, so that is an improvement. 49.7, if it goes up over 50, it will be very bullish. At the same time I say that, very bullish, that I'm giving you the mechanical signal, but you also have to take into account this has been flip-flopping back and forth like a fish on the deck, and not been very helpful of late, and that's a reflection that we are in this kind of sideways pattern. We're in the muck. So don't make too much of any of these signals until we get breakout and confirmation of that breakout out one side or another. All four, I said, were bullish. They are. In fact, 3 of the 4 are in range of going mechanically very bullish. Russell improving. It was in that very low reversal area at the bottom with severely bearish, and it is now up to a 36.8. Overall hedge warning status remains level 2, which is our red light. This is not a prediction that the market is about to go down significantly or how far it's going down, but it is a assessment and opinion that the current market risk level is relatively high on a 0 to 3 scale. We've got this at level 2. Conditions are present, a number of volatility and other warnings are present, such that if this market were to break down, it could break down hard and relatively fast, and you need to be aware of that as you make your decisions. In terms of the specific warnings, we have a market in decline, and a sharp increase warning came into effect yesterday. We had a futures daily squeeze on the VIX fire 2 days ago, and that has positively exited, so that is not a good sign for the bulls. In terms of the skew, it remains elevated as it has much of the last couple of months. It's right now at about a 6-fold increase in probability from the normal that we could have a 2 standard deviation move in the next 30 days. And this certainly has been proven out in trading during these last few weeks. This elevated skew, we've seen a lot of standard deviation moves in December. In terms of current week out, expected move on the SPX is right at 45 points. That's somewhat elevated. That should also be taken as something of a warning as to increased probabilities of delta moves. New highs, new lows, nothing there, very benign. In terms of the risk aversion indicators, we currently have 4 as right on risk on. I went ahead and called them risk on. They're very little separation, but there has been crossover, and they are technically in a risk-on condition. So certainly conditions have improved in that area. We've had some improvement also in fear and greed index. This number is not as low as it was, and it's up to a 42. In terms of the special opinions, option income strategies, VIX is inside the acceptable window to initiate new positions. For novice traders, I would continue to caution to be defensive and cautious about opening new position. This market has been chopping in and out of the acceptable window for novices. More aggressive traders will find the elevated premiums and the price action to be favorable. You just have to be prepared with your capital allocations to be able to make those adjustments, because we could have certainly elevated probabilities to large delta moves as well as large vega moves. In terms of cover call strategies and put selling, also conditions acceptable, but a very, very choppy market that is apparently range bound. That can be productive for both covered calls and put selling if you set up a proper defensive tactics, your ratio of in the money and out of the money, your ratio of higher beta, lower beta. There's a number of things here, and I've suggested a number of things as you read this that can be done to be more defensive, and right now the market would certainly call for a more defensive structure. When you're hedge risk level 2, there's nothing wrong, frankly, with not putting on any new bullish positions until we break out of this pattern and improve somewhat. It also, for those that like to start picking on early entries, this is the time that you would start putting on some core put positions, some conservative covered call positions, picking at those early entry opportunities. So we're really quite borderline. As you can see from all this language here, we're really quite borderline. If you want to start initiating some positions, it's certainly within the opinions that would be acceptable, and yet at the same time you have to know that you're being somewhat aggressive and that the market could break down given the current conditions, and then all your positions would be being challenged in a big way. So this is not a very friendly, very strong bullish market whatsoever, and you've got to be taking that into account. In terms of sector specific, It's kind of a Christmas tree. We've got all the colors are going all the directions. Let's speak about the weak ones. Transportation, energy, and retail continue to be, on the most wanted list in terms of weak. In terms of positives, you see a number of these that are positive. Some that have been more consistent than others. But certainly a lot of these have been flipping back and forth with the price action that we've had in the recent couple trading weeks, and I wouldn't make too much of these signals right now other than to look for consistency as to which sectors seem to be the first to go down and which sectors seem to be the first to go up, and that might give you some measure of where to put your watch list together. In terms of sector percent change, you see the ones that were positive yesterday were pretty minimally positive. Utilities, consumer discretionary, telecom, very minimally, though some of these that were negative were strongly negative, with energy down almost heading towards 2%. Okay, that should be enough for today. In terms of special opportunities, again, I'll mention about the covered call mastery course. More details are imminent to be released about that. But this will be a very, very comprehensive course. So if you've had any thoughts about learning more about how to put together a really good strategy on this, I will be providing that in January. Also, I would say that if you've ever thought you wanted to learn about how to use options, this is the way to step into the world of options. This is absolutely the best way to get started with that. Covered calls are actually more conservative than owning the stock by itself. So if you're thinking that options are risky, well, at least with respect to covered calls, I would make a very strong case that a covered call is less risky than owning 100 shares of Apple by itself. If you think you might be interested, just send me an email to steven@falconglobaltraders.com, and I'll put you on the list for those that want more details when those are released, and I expect that to be very soon. In terms of if you find that this early morning market preview is helpful to your trading, you can acknowledge that by liking it on YouTube, retweeting it to your Twitter followers, to your StockTwit followers, subscribing to the YouTube channel. We can continue to grow in our subscriptions to the YouTube channel. It's a free subscription, and by subscribing to the YouTube channel, you also get a heads up when that content is posted. I try to generally post this video each morning by 7:30 a.m. Central Time, though that varies depending on what's going on at my trade desk in the morning, and certainly today I'm later than usual. Disclaimers as always, hit the pause button if you need more time to review, and then at the bottom you see the hyperlink to go to the full disclaimers. Well, let's put that to bed for today. Let's put this back towards tomorrow, and I'll be back to provide this market preview from Falcon Global tomorrow morning before the market opens. In the meantime, good trading to all of you, and a happy holiday season.